Hey, it's Marcus Larrea here at Palm Paradise Realty Group. And yesterday we got some great news from the Fed that they will be cutting interest rates by 0.5 point. It's a little bit higher than expected, as most experts were predicting originally that there would only be 0.25 point decrease. Today we're here with Nate Tasso with Motto Mortgage Freedom, and he's going to discuss today briefly about what this means for you, the consumer. Great to have you here, Nate.
Thanks a lot, Marcus.
So Nate, the rate cut came in at 0.5 point. What does that mean for the consumer?
That's a very good question. The 30-year fixed is tied to the TNX index. And what I'm going to talk about today is just mortgage rates. So whenever you see the Fed cut rates, the lenders have already baked in the rate cut. So we're not seeing a significant move in rates today due to the fact that the investors that purchase mortgage-backed securities have already baked in the rate cut. So we're not seeing a significant decrease in that. What this means for consumers is lower costs. If you look at just 1 year ago, the average rate was 7.78, and today it's 6.09. So if you take a look at a $400,000 loan, the difference in the payment's $456 a month, which is very significant.
And how is the interest rate cut going to affect the number of mortgage applications?
Yes, so we're going to see a significant increase in mortgage applications because this is getting people that couldn't afford before the ability now to purchase. And the main reason is what I just talked about before, was the debt to income ratios and other things that will make it more easier for them to qualify.
So can you talk briefly about refinancing? The buyers that bought in the last couple of years at a higher rate, what do you recommend for those people to refinance? Is now a good time?
Yeah, so whenever you're going to refinance a loan, what we have to do is look at cost justification model. Is what difference in what you currently have in interest rate versus what it will be is, I think it's about 3/4 of a point, 0.75% or less. So what we take a look at is what are the overall costs associated with refinancing, because there is closing cost, and how many months does it take to make up for it. So usually if you can make up for it in 14 months or less, then the cost justification makes sense to do the refinance.
Thanks for the insights, Nate.
Thanks so much, Marcus.
So what does all this mean for the housing market? Well, as interest rates start decreasing, we should start to see stronger demand. Inventory has been relatively high both nationally and locally. So with this increased demand, we should start to see inventory start to decrease. As inventory starts to decrease, prices will most likely begin to rise again. So if you're in the market to buy, I highly recommend looking to make a purchase in the next few months before demand increases and inventory drops, increasing purchase prices overall. You can always look to refinance your loan, but lock in that low purchase price of the property now before demand starts pushing prices up. To learn more, connect with one of our experienced team members at Palm Paradise Realty Group today. Thanks for watching, and we'll see you in the next one.